In this lecture, we will learn about how businesses conduct transactions. How do these transactions affect the financial position of the business and the concept of accounting equations? Let's begin with a transaction understanding. What does a transaction mean? In a business, a transaction occurs by exchanging goods or services for money. There are at least two equal action impacts. Something is given and something is received. For example, buying a computer, borrowing money for business making, and receiving money paying salaries, and more example. All business transactions that involve money and will need to be recorded. Let's take the case of Daniel's Consulting Services, owned by Daniel, a firm that provides accounting and consulting services. Look at a few transactions after starting the business. Daniel purchased new equipment for $20,000. This is a transaction as it involves an exchange of goods for money. There are two equal actions: equipment is received and money is given. Daniel issued a check for $32,000 for the rent and be paid in advance for the months of December and January. This is a transaction as it involves an exchange of renting facilities. There are two equal actions. Facilities have not yet been received and money is given. Every transaction has an impact on the business's resources. The resources of a business refer to its supply of goods, services, information, or expertise that allows the business to operate and grow. In accounting, the resources of a business are classified into three broad categories, namely assets, liabilities, and owner's equity. Assets are what a business owns or what is owed to it. It includes items such as cash, accounts receivable, merchandise to be sold, supplies, equipment, and land. Assets also includes intangible items such as patents, franchises, and copyrights. Liabilities are what the business owes to others. Some examples are payments to be made to suppliers, salaries to employees, taxes to government agencies, rent to landlords, mortgage and loans, and interest payments to financial institutions. Owner's equity is the money that the owners of the business have put into the business. It also includes the owner's claim on the assets of the business or investment in an asset after deducting any liabilities. For example, if the business owns assets of $424,000 and also the business owes from outsider $24,000 to run the business, meaning shows the business owes from owners $400,000. Owner's equity also consists of the amount of profit a company makes at a certain point in time. These three accounts are referred to as the financial position elements as they relate to the three key items in the financial position statement. Apart from this, we also have income and expense accounts that are related to the comprehensive income of the business. For example, revenue from sales will go into income accounts, while expenses such as salaries paid and bills settled will go into the expense accounts in the accounting books of the business. Accounting also uses a technique to show how a transaction changes the business's resources while maintaining a balance or showing the equal value of the exchange. This is called the accounting equation. The accounting equation is that the stuff the business owns is equal to the stuff that the business owes. That helps us understand how various transactions affect the asset, liability, and owner's equity accounts and how these accounts are related to each other. The accounting equation is presented as assets equal to liabilities plus owner's equity. In the case of a corporation, instead of owner's equity, we have shareholders' equity. As many shareholders invest money and have equity stake in the corporation, the equation will always be balanced. So if the business has assets worth $80,000 and owner's equity of $20,000, then we can say that the liabilities are equal to $60,000. Every transaction will affect at least two of these accounts. If a transaction causes one side of the equation, assets, to increase, then the other side of the equation, liability or owner's equity, must also increase to keep the equation in balance. It is also possible that an increase in one asset causes another asset to decrease. In any case, the accounting equation will always balance. Let's take the transactions at the Daniels Consulting Services and see how they fit into the accounting equation. The very first transaction occurred when Daniel invested $400,000 in the business. This $400,000 is the capital or owner's equity in this transaction. And I said in the form of cash is created for the business. The next transaction happens when Daniel buys a new computer and other equipment for room $20,000. Both the computer and equipment purchased and the cash paid for the assets. So in this transaction, there is an increase in one asset and a decrease in another asset. The third transaction happened when Daniel purchased another piece of equipment on credit $24,000. This transaction is an increase in assets and also an increase in O's, refer to liability. We saw that the accounting equation contains three accounts, namely assets, liabilities, and owner's equity.